We've got a big week for the stock market this week. Last week, of course, we got non-farm payrolls sizzling, hot number, far more than I had expected, and the stock market broadly speaking. But what does that mean for the stock market moving forward? Tomorrow we get CPI data, and then Thursday we get PPI data. And how does that incorporate into what will happen with interest rates? As it's looking, and as I've been saying for months now, I do not see the Federal Reserve lowering interest rates this year. I actually expect they could raise interest rates. Let's break down some of the data points that could affect the Federal Reserve's decision. And of course, last week we had one Federal Reserve president who is not a voting board member, I don't believe, who basically said, I don't see how interest rates could go down this year. That rocked the stock market. Let's look at some data points. Accommodative or restrictive? This is what we're really asking the question right now with inflation. Inflation is the Federal Reserve's primary concern right now. They have a dual mandate: price stability and maintain full employment. They'll sacrifice employment in order to maintain price stability. The goal, of course, is for them to, their target rate is 2% on inflation year over year. PCE data points came out a little earlier last week or the week before, and they basically said that inflation is a lot hotter than expected. Month over month increase was 0.33%. Multiply that by 12 for a whole year. If we continue to get those month over month increases, you're looking at a 4% inflation rate. That's double what the target rate is for the Federal Reserve. Inflation is not moving downward to a point where the Federal Reserve can sit there and say, we can lower interest rates. Interest rates right now, accommodative or restrictive. If we're not getting inflation down to the 2% level fast enough, then this level of interest rates is not restrictive enough. Once the Federal Reserve does get a clear pathway to the 2% level, then they can lower interest rates to a neutral stance to see where things are. The way I see it right now, inflation or interest rates are roughly neutral, but inflation is too high. 4% is too high. Given that, non-farm payrolls came in at 303 as we're looking at this chart right here. That's huge. That's hot. It can perpetuate inflation. But inflation is more than just consumers buying goods and services. We're seeing some delays in some inflation numbers, such as insurance is moving higher. Insurance companies are going to have to wait to raise individuals' premiums, and they may only be able to do that on, say, the annual basis, or they may have to let regulators know, hey, we're raising our rates for premiums. So we're seeing some different kinds of inflation. So it's not necessarily whole consumer demand driven inflation. Nonetheless, 303 non-farm payrolls is not exactly easing. Here's a look at the civilian labor force, which did increase. It's been kind of sort of bobbling around sideways. The civilian labor force, what they do is they look at the entire population that is eligible to work, and they ask, okay, who does want a job? And if you've been off the payrolls for any kind of period of time, say 9 months, 12 months, and maybe you have that one PhD where there's only one company that could possibly hire you, but you wouldn't dare go work for McDonald's at the French fry station, the civilian labor force would not consider that individual. Number of unemployed kind of eased a little bit from the previous month's numbers. This gave us the unemployment rate of about, I think it was 3.83%, which is still well beyond full employment. We used to consider 5% full employment. Now at 3.8%, there's plenty of transitional individuals there that the Federal Reserve could sacrifice to get their inflation target rates where it needs to be. But I don't necessarily think that a lot of the inflation we're seeing right now is necessarily because of consumer demand. You get certain things such as the mortgage rate, which is housing. It's driving housing. Prices have been kind of easing off a little bit from their spike up higher recently because of a pull down in the mortgage rate, but that's having an additional effect on demand there as well. Bond yields. Here's a 10-year Treasury bond yield. This is the one I default to all the time. It's the benchmark investment rate. And as you can see, 4.43%. This was as of last night when I put this together. I did see it ease off about 5 basis points down to about 4.38%. Regardless, certainly not heading lower. We've seen interest rates at these levels earlier and how that affected what happened with the stock market back in October. We're seeing a slight ease back right now, but what will inflation show us tomorrow and moving forward? Inflation, the number that we'll see with CPI, which is a pretty good indicator of what the PCE will show 2 weeks later at the end of the month, inflation is still too high. Because of that, the Federal Reserve is not in a position where they could lower interest rates. Here's a look at the stock market itself, broadly speaking, kind of moving sideways after the most recent moves. We've seen interest rates kind of moving up and down. Remarks from Federal Reserve President out of Minnesota, who kind of sparked a bit of a sell-off when he said he didn't see interest rates moving lower. I see interest rates, given the current level, that it's not restrictive enough. The Federal Reserve could potentially raise interest rates. Now, we are also seeing things like oil moving higher. Gold has hit an all-time high. You're seeing some commodity prices. Don't even bother looking at cocoa. Cocoa's like pushing 10,000 at this point. It's ridiculous. But that has nothing to do with inflation per se, but it will hit consumers at the markets as well. We're seeing some assets being overinflated. Bitcoin, Ethereum pushing highs, popping back up this morning. This is sort of a, broadly speaking, an asset increase, and that tells me again that interest rates are not at a restrictive level. Otherwise, we would see the stock market moving lower. Given that, there's your signal right there. If we get inflation numbers that are a little hotter than expected, you can expect the interest rates to move higher, and because of that, stock markets could sell off. This should be a huge warning sign for a stock market that seems to be running. Here's a look at core PCE inflation deflator. Now it is moving lower, and I think it's like at 2.9% at this point. But again, the month-over-month annual increase is too high. Regardless, it is moving in the, broadly speaking, the general direction where it kind of has been trending towards. Generally speaking, however, the core PCE index is roughly about 1.5 to 1.75%. We're still very hot. I think it's like 2.85, 2.87% right now. And this is what you're really going to be looking towards, because the PCE is what the Federal Reserve looks like. CPI gives us a pretty good idea. Jobs, a lagging indicator, is moving higher, which that would show us that inflation is likely to move higher or remain high, sticky. Given that, the way I'm playing this, I'm looking at volatility. Volatility will probably spike up again tomorrow if we get a hot number coming in. Interest rates probably going to spike up a little bit higher, but that might be a small spike and then just a continual move higher and higher and higher on a regular basis. I don't see necessarily a big move there, but regardless, I do not see the 10-year Treasury yield moving lower. We're probably going to continue to see sticky inflation, and that's going to really drive things. For those of you who've been following me for some time, I'm transitioning my website, Substack. I'm moving to Substack. There is a link down below if you want to get the written material on this. Plus, there's also value investing portion of the newsletter there. Make sure to hit the link down below to sign up for that. I am importing everything. It's just taking some time. I'll get there. In the meantime, for those of you who are just finding my channel for the first time, like and follow down below. We'll see you in the next video.